We're going to kick off today's session with a conversation with Evangelos Simoudis, founder and managing partner of Synapse Partners. Evangelos, welcome to the show.
Thank you very much for having me. It's a pleasure to be here.
Well, let's get acquainted. Tell us about the fund's investing focus, your background. What size investments do you make? What kind of things do you like to dig into?
So I'm based in Silicon Valley, where I've been here for about 30 years now.
Where are you from?
Originally from Greece. Came to the U.S. about 40 years ago to go to school. And ended up staying. So I started my career as an engineer. My PhD is in computer science and machine learning and very large databases. So
your time has come.
I'm sorry?
Your time has come.
Yeah. Well, let's call it. This is the second spring, the AI spring that I'm participating in. But during the first spring, in the 80s and early 90s, I was working in technology and did my first startup. Came to the Valley 1990 and worked in startups and large corporations. And then in 2000, I moved over and became a partner at Apex Partners, which was a private equity and venture capital firm at that time. Then moved to Trident Capital, and about 2.5 years ago, we started Synapse. And at Synapse, we invest exclusively in early-stage startups that develop enterprise applications that combine big data with AI-based data exploitation technology. So we're not looking only at machine learning, but other AI technologies that that can take advantage of data and can convert data to insights.
So how big is the fund?
So we're investing. So we have a very interesting structure in that we're investing both private money and we're also collaborating with a number of corporations. So the structure that I wanted to give to Synapse came out of my experience both as an entrepreneur but also as an investor with more traditional institutional venture firms. And we're essentially, there are three pillars to what we do. The first is, as I said, we focus exclusively on a particular sector around big data and AI, and we invest in both horizontal and vertical applications. And with regards to the vertical applications, we look at three industries, automotive and by extension transportation, financial services, and telco. Second pillar is that in order to execute on this vertical industry focus, we partner quite closely with corporations from these three industries. And when I say we partner, we not only co-invest, but we spend considerable amount of time with top executives from the CEO on down in these corporations that are our corporate partners, and try to understand what are strategic problems they have, which can be addressed through the application of and AI. And I would say today, about 60% of our investment theses are coming through these interactions. The third pillar is that we maintain a quite significant database of startups that work in these areas that we invest in. So our database today has about 5,000 startups that we track and track many different attributes of those startups. And we try, in a sense, we try to practice what we preach, and we constantly analyze that data to identify important investment opportunities. So at least 70% of the investments that we have a portfolio today of 15 companies. We've made 17 investments as a fund, and we've had 2 exits so far. But of the 15 active portfolio companies, at least half we identified through analysis of this database.
Mm-hmm. And so you didn't answer my question about the fund size. What size funds are we talking, and what size checks are we talking?
I think the second part of your question is more important. So we start. First of all, we invest in early stage companies that have a little bit of revenue. So we like to see some proof of revenue, some proof that the solution that the companies are developing is being accepted by the.
What is a little bit of revenue? Are we talking in SaaS terms? Are we talking $10,000 MRR? Are we talking $100,000 MRR? Where are we?
So the investments that we have made tended to have initial revenue from $200,000 to $1 million when we came in.
Annual.
Annual, yes. And now,
annual. Okay. Okay.
Depending on the sector, this revenue may be license revenue or initially may be NRE revenue. So if you think of in the automotive area, for example, where we have a significant number of investments in the auto tech sector, it takes quite a few months for an automaker or a tier 1 supplier to sign a license contract with a startup.
Long sales cycle.
Right. So, but in the intervening time, these companies are doing larger and larger pilots and other projects with the startups. So let's give you an example. We invested in a company called Divergent 3D. It is an LA-based company that has developed a data-driven manufacturing system for producing large components of automobiles using 3D printing. That company recently received a $100 million round, and we invested in their first 2 rounds. The $100 million is their third round, and they're still working on larger and larger contracts. Now, their contracts are multi-million-dollar contracts now, but they're still project-based contracts for the OEMs that they're working with.
So your business, what I'm hearing is not necessarily a software as a service revenue model business. You see a lot of large deals that are not necessarily recurring revenue deals.
Well, again, this is it depends on the industry, and it depends on whether the company is a horizontal application or a vertical application, and if it's a vertical application, which industry it is working on. So I'll give you a couple of other examples. We've invested in a company called TopOps, Missouri-based startup that is using machine learning and data in order to focus and reprioritize the sales pipeline of enterprises. In their case, again, it's a recurring revenue model, traditional, subscription model. So again, but it's a horizontal application. So it really depends on the industry. So we come in at this level and we write anywhere from 100 to low hundreds initial check, and then we don't take a board seat. So we tend to work with syndicates of investors that we know, and again the the fact that I've been in the Valley as an investor for many years. That helps a lot in both being invited into certain syndicates, but also creating syndicates.
So you lead deals?
We don't.
You don't.
This is something that, again, I've been in the business for a long time, and this time around I felt that I do not want to be on boards. In a few companies, I'll take a stronger advisory role. We also have a very strong advisory board in the firm, and our advisors are also getting very involved with our portfolio companies.
This is interesting because you're saying that you do extensive analysis of the companies to find investment opportunities. So how does it work? Do you initiate conversations with them and then you bring your syndicate together and somebody else, you recruit the lead investor, or how does it work?
It varies. We typically start a conversation with one or more companies in a particular sector, either because we hear for some of our partners or some of our advisory board that this is an area that we need to be looking at. Also because of my own background, I tend to have certain ideas of areas that I want to work in. So we start these conversations, and then if there is if the management team is already talking to other investors, we are introduced and work together. Other times we bring together a syndicate and them our diligence.
And so what kind of check sizes are we talking about? Low hundreds to?
Maybe $500,000.
Okay, got it. So let's talk a little bit more about the portfolio companies. Let's actually talk about the two that you talked about that have exited already. And give us a window into what kind of company they were and what attracted you to them and what stage did they come to you at. And I like to do this just to understand how the investor guests we have on this forum, how they think about their investments. So I think it provides a lot of insight to see what they've invested in and why.
So because we look at early stage companies, initially what we consider is, number one, what is the problem that is being solved and how relevant is this problem to one or more of the investment theses that we have. And as I said, we formulate this investment thesis both by interacting deeply with our corporate partners as well as with our own advisory board. And the thing that we look at is the type of intellectual property that the company is developing in order to address the problem that they're solving. So, and again, we both members of my advisory board as well as myself who get very involved in trying to understand what is the hard IP that is being developed here. So we talked earlier about Divergent. Again, the hard IP is both identifying what type of alloys to introduce into these structures that they're making, as well as how to design the structures in order to to provide safety in the vehicles where the structures will be incorporated. So data and AI play a very, very important role. It's a very hard problem. It's almost like dealing with fractal geometry in that space. But if you go back to, you asked about the companies that have already exited. So the one company was doing was developing a reporting tool that was using artificial intelligence and knowledge about queries that have been asked in a data warehouse to automatically create the right query and optimize it, right? So that meant that novice business analysts that wanted to interact with the data warehouse can create very sophisticated queries without really understanding what's going on behind it. The second, and this was acquired by Box. The second company was a security you can call it security analytics company, and again, we invested in them because of what we heard from three of our telco corporate partners, which is that they wanted a very flexible way of looking through the security alerts that they're getting into their corporate networks. And as you can imagine, a global telco may be getting millions of alerts per day. And so they wanted ways to do that both effectively and relatively inexpensively, because in order to capture the data to analyze for those alerts, they end up spending a lot in storage, as you can imagine. So this company again had developed this type of a solution, and they had already deployed it with 3 customers. We've introduced them to additional customers, and early this year were acquired by FireEye. Again, what we in both of those cases, initially what attracted us was the IP that was being developed. Eventually, also we got convinced that the team that they had really had the right characteristics. They were hungry entrepreneurs. They were.
Did they have a pilot already underway, a paid pilot already underway when you got involved?
They did. In the first case, they had 2 customers for their early customers for their solution. In the second case, they had 4 or 5 customers, some smaller, some larger, but we could see that in both cases, both how the IP is working, but also what else needed to be done and how the money will be spent and the like.
So how did the acquisition come about? And I'll give you a bit of context about where I'm going with this question. It sounds like you are open, you and your syndicate partners that you work with are open to relatively early acquisitions. You're not trying to go for this unicorn kinds of companies. And I happen to believe that that's great, because I think there are many, many, many more opportunities out there that are, mid-sized opportunities, smaller opportunities of building, very interesting, very compelling companies solving very interesting problems, but they don't necessarily have multi-billion-dollar TAMs to build these, unicorn types of ventures. But one thing that I've heard from a number of investors who are following this strategy of not necessarily chasing unicorns but are okay with early exits is they try to develop deep corporate relationships so that the acquisitions, they have some window into what they're doing and who might be interested in acquiring those companies. So I guess that's where my question comes from, is that you seem to have very deep corporate relationships. You seem to have an interest in, relatively early acquisitions. How do these acquisitions come about, and what relationships do you have with these acquirers?
So first of all, I should say that having built a couple of and sold a couple of startups myself, as well as having been an investor now for coming on 20 years, that builds certain know-how, certain experience, which influences decisions. Okay.
Yeah.
You invest in early stage companies, particularly if these companies are going after relatively new markets. You do not know whether the market will materialize in the way that every VC is thinking about, large multi-billion-dollar market with huge exit, or whether it's going to be something more modest. Okay, so early stage investing requires agility that other types of investing do not. So we've always been, even when I was with my other firms, we've always been looking at when does the company have the potential to go and become big and execute properly and capture a significant part of a large market, and when a company, either because of its execution inability or because of the market that it's operating in or because of competition, it can never reach the potential that you initially thought it could reach when you were making the initial investment. That also means that the management team, the founding team, and eventually the management team needs to be in sync with the investors, right? So a lot of times, as I said, we start looking at a company around the IP that they're developing, the problem they're solving, but eventually, and certainly before we invest, we vet the founding team and the broader management team quite well, because we need to understand how flexible are they. We've met companies that they want to be unicorn without really understanding whether they can be a unicorn.
Right. Absolutely, we see that too. Yeah.
And we also bring together again. Once we feel happy with our understanding of the management team, we do the same thing with the syndicate, right? So we need to make sure that the investors that we work with are really of the same mindset. Really can demonstrate and have exhibited the kind of flexibility and agility that I was referring to. So there's a lot of science and art that go on into selecting the right management team and selecting the right co-investment partners before you go into this. The last comment I will make is that while we do have these very deep relations with our corporate partners, in these two particular cases, the exit did not happen to one of our corporate partners, but happened to other companies. And again, that's important for every good VC needs to have a multitude of relations that they bring to bear as they into their portfolio. So, but I will give you other examples. So we have a portfolio company called Renovo, also from the automotive technology. So Renovo has developed an operating system that uses, again, AI to predict and to fuse all the data that is coming from the sensors of autonomous vehicles. And there are hundreds of sensors in autonomous vehicles, so you're talking about very large quantities of data. So they have received an investment from two of our corporate partners, Verizon and Samsung, and they have developed also working relations with those, or partnerships with those corporations. So we always try to do that matching, and because of the deep understanding that we have of the problems that our corporate partners are trying to address, we're not only able to make new investments, but more importantly, we're able to materially help the portfolio companies in their mission.
So it sounds to me, if I were to synthesize what I've heard from you, is your relationships are more with the corporates who are either co-investing with you or becoming early customers of your portfolio companies, not necessarily with the acquirers, and the acquirers are coming as you go along and develop the businesses.
I mean, for us, when we select corporate partners, it is important to identify companies that are thought leaders in the spaces and in the industries that we want to work on, because we feel that it's through these thought leaders that we will find the hard and important problems that need to be solved. And as I said, we don't invest in companies that address every single problem we hear about. We we hear from our corporate partners about a multitude of problems where data can play a role, but then we have to apply our own filters. We use our advisory board. We use our own other networks to identify the subset of those problems that have the potential to have big impact, right? So because you don't want to invest in a company that solves the problem of just one corporation, right? You want to invest in companies, in startups that solve problems that are important to a big. So I'll give you another example. We recently invested in a company called Humanizing Autonomy out of the UK. Again, we don't invest all in the US because we don't take board seats. We look at investments globally. So we have investments in Israel, in Germany, the UK, and in several parts of the United States. So in this particular case, again, when we started looking at humanizing autonomy, the problem that they were trying to address is predict pedestrian behavior, and that's an important problem in automated vehicles, not only autonomous but broadly automated vehicles. But as it turns out, it's also a very important problem to other forms of transportation, so buses and light rail systems and airplanes, because again, the idea of how a pedestrian behaves, whether they are boarding an airplane or whether they're boarding a bus or they interact with a light rail system and obviously and ultimately with an autonomous vehicle are big problems. So now, whereas initially we thought that the market would be kind of like this much, by the time that we finished our diligence, we determined that the market would be, much larger because there are all these other opportunities.
Great. So it's also interesting that you said that you're investing globally. That's been completely consistent with what we are doing, so that's a good fit. I will ask you one last question, which is before we start the entrepreneur pitch session. My last question to you would be, what trends are you seeing, and specifically in the AI deal flow, in the kinds of verticals that you are working with, what are the trends?
So I would say that to a certain extent, it is all over the map, right? So we continue to see significant interest in next generation mobility technology and technologies. So it's not only about creating autonomous vehicles, but also monetizing that autonomy. So right now, in fact, autonomy monetization is one of the investment theses that we are actively pursuing. We've made one investment so far in a company called Safecraft, and we're looking at additional opportunities. We continue to, so as we get into these larger scale data sets and more applications of automation, we're starting to see a variety of robotic applications for several industries. And then, again, the harder AI problems around natural language processing, natural language understanding, computer vision. So the main reason we invested in humanizing autonomy is because in the process of solving this predicting pedestrian behavior and understanding pedestrian behavior, they really have to solve a hard computer vision problem. And so the bet is that if they solve it, then that's going to be a big reward, but it's also a big risk type of an opportunity. We continue to also see companies that want to automate parts of the entirety of the predictive model creation process, which is becoming harder and harder as companies are realizing that there aren't as many data scientists as they will want to hire, but also as the data sets are becoming larger and more complex, higher velocity, higher dimensionality, lower quality, automating parts of that process becomes maybe even in an industry-specific way becomes important. So we've invested so far in two companies. We've invested in a company called Paxata. We've invested also in a company called Ikasi, both here in Silicon Valley. But we're looking at additional opportunities. And finally, look, cybersecurity remains a global problem. Some aspects of it are domain dependent, so we're looking, again, we talk about autonomous vehicles. They will need to be protected.
Absolutely.
So we've invested in a company called Namogu out of Israel that is using, again, big data to address a specific aspect of security. We're looking, there's a lot of noise in that space, but again, it's a big problem, it's a big space.
Great. Well, very interesting conversation. You obviously have a lot of deep insights into AI, and it's we are hearing from every corner of our universe. We are hearing AI in its various different shapes and forms. So it's been a great conversation. Thank you for sharing your thoughts, and nice to meet you, Evangelos.
Goodbye. Thank you.